the potential strategies you can look at to tackle the Division 296 tax? And is it okay to do nothing? Let's get into the advisory and join John Vanderpoel from Morgans. John, great to see you. Is it okay? Is it okay to do nothing here?
Well, yeah, we've certainly got a few clients who are doing nothing at the moment. No, that's neither right or wrong. I mean, there's at the end of the day, we still don't have the legislation, and that's the critical point here. We expected that Div 296 legislation would go back into Parliament during the current sitting, but the Albanese government, for one reason or another, has decided to defer it until after the Productivity Roundtable, where we call it Productivity Roundtable, but it looks like it's going to be a tax discussion more than anything, with CGT, negative gearing, trusts, GST, everything on the table. And then I think they're going to come back to us at that point and let us know what to do. So I think sitting on the sidelines for the moment, keeping in mind you've got to the 30th of June 2026 to implement change, is probably not the worst idea.
Yeah, maybe not. In terms of what we're seeing, though, and you touched on that productivity roundtable, is being welcomed by a lot of economists here. If it does go down the path of looking more closely at some of these tax changes, what does that mean for people, particularly when they're looking not only at Division 296, but broader estate planning considerations as well?
Yeah, look, there's a whole lot to consider. I mean, there's, keeping in mind the company tax rate is 30%, and we don't know what's going to happen there. Personal tax rate, the top marginal tax rate is 47%. So the danger is, with the unknowns around capital gains tax changes, negative gearing and the likes, you could kick money out of superannuation going, well, I'll avoid Division 296, but then you get captured somewhere else. But estate planning just gets more and more important. So, it's not uncommon to sit down with a client who's got a self-managed super fund with a really outdated trust deed that may not even reference reversionary pensions, which is a common strategy employed by clients for managing their money on the death of a member. You've got to make certain the will's up to date, the enduring powers of attorney are up to date, trust deeds are current, binding nominations are in place, reversionary pensions are in place if required. It's a conversation I have with clients constantly, that they just don't have their ducks in a row there, and this is the things that could really cost your loved ones a lot of money.
It could indeed, and that's always such a tricky time as well, isn't it, when you're dealing with grief and also estate planning, as you say. What happens as well if a fund receives an insurance payout?
Yeah, so like whether you receive a life insurance payout, a TPD payout, or a terminal illness payout, that will it won't count from an earnings perspective, but it will go onto the total super balance, and it will be captured under Div 296. So that is a question coming up for our clients, going, well, what happens if I get this insurance payout? Is that excluded? Based on our understanding of the legislation at the moment, no such luck, unfortunately.
And John, more broadly, what are you seeing in terms of demand for advice, given we're 1 month into the new financial year?
Yeah, well, look, every day's fielding calls on Div 296. I've got quite a few clients who are captured by it, and some have made their decision. Just broader conversation again. We're having clients who are withdrawing money from their super fund now, and this is where you've got to be careful what you wish for when you're politicians. They're sitting there and making an assumption that they're going to raise X amount of revenue from Div 296. A lot of clients are being advised by accountants and advisors to take money out of super, bring forward inheritances. And the big one here, Juliet, is that clients are actually going, you know what, I might upgrade my home, because don't forget the principal place of residence is an exempt asset for all purposes. So if you want to avoid future death taxes, problems, maybe relating to Centrelink, take your pick, you could have a $20 million house, and that's exempt when all these discussions take place.